Hey, what is up guys? In this video, I'm gonna break down interest rates to you and how it would affect you when the US Fed decides to increase it in the coming months or years. Understanding interest rates is crucial in your journey in the world of finance because, like it or not, it is fundamental to almost everything in our lives. Your savings and investments, your mortgage and car loans, your business, inflation and economic cycle, it's all affected by interest rates. So strap on tight because we got a lot to go through in this video, and without further ado, let's jump right into today's content. Before we even talk about the US Fed, let's start by understanding what is interest rate. By definition, it is the amount a lender charges a borrower and is a percentage of the principal or the amount loaned. If you have not borrowed money from banks before, then no worries, you will at some point in time in your life require to do so. As individuals, we borrow money and repay it over a longer period of time in smaller pieces for mortgages, vehicle hire purchase, credit expenditures, starting a business, and to some extent trading in margin. All of those transactions come at a cost that we call interest, which is determined by the interest rate. Vice versa, when you deposit your money in your bank in the form of savings or fixed deposits, that is effectively the bank borrowing money from you, and hence they have to pay you an interest as well. If you notice one thing, the banks will always pay you an interest rate lower than your interest cost of a loan. That's because when you place money in a bank, your borrower, which is the bank, has a near zero risk of default because they are backed by the government. And on the opposite end, when the bank lends you money, you as the borrower has a higher risk of default since you are only backed by your income power, your credit history, and so on and so forth. Hence the higher interest costs. This difference results in profits for the banks, and that is basically the main business model of a bank. They love to borrow people money so that they can increase their profits. Now, why do we have to pay interest to the banks? Can't we just repay them for whatever amount that we borrow at the beginning? Well, that's because banks are businesses as well. They have employees to pay, they have projects to run, and they need to pay for overheads to run their banks and etc. But most importantly, the interest payment revolves around the concept of time value of money. Simply put, your money today is worth more than your money in the future. You would agree that your $10,000 today will be worth more than the $10,000 5 years down the road. That's because there is inflation going on in the background that devalues your money over time, on top of the country's currency fluctuation, risk profile, and etc. So when the banks borrow you money today, they have to compensate for the loss of value over say 5 years of your repayment period in the form of interest cost. Because if not, they will be out of business and the country's economy will go down the drain, right? And applying the same concept to businesses, they love to borrow money to fund their capital requirements and operations, because if their interest cost comes at a rate of say 10% per annum, while their annual return amounts to say 25% per annum, then that difference between the 25% and 10% results in a return of 15% per annum. This concept is what we call leverage. We take advantage of the bank's money to make more money, or in another word, we borrow $1 to make $3. Fascinating, right? Anyways, I digress because one does not talk about interest rate without understanding the concept of time value of money. Now, how are interest rates determined? Well, we can split this into two types: short-term and long-term interest rates. The short-term interest rates usually refer to the US Fed Funds Rate, FFR, set by the Federal Open Market Committee, FOMC, led by Jerome Powell, which is defined as the average interest rate banks pay for overnight borrowing in the federal funds market. I'm sure you must be scratching your head right now. To help you visualize it better, imagine each bank has their own Federal Reserve account and they have to comply to a certain reserve requirement set at the end of each day as part of the financial regulations. If Bank A does not meet that requirement, then Bank A has to borrow money from Bank B that has more money in their Federal Reserve account, and that money is borrowed at a small interest rate which we call the Fed Funds Rate, FFR. This transaction is usually done overnight and it actually behaves like a sale rather than a loan. This FFR can be controlled by the US Fed through some complicated tools but we are not gonna go down that rabbit hole. But what you need to know here is the change of FFR will directly affect how the banks behave, because they will pass through the effect of it towards the consumers, which are people like me and you. The second type of interest rate, however, which is the long-term interest rate, usually refer to the US 10-year and 30-year treasury note yields, aka the bond yields. Bonds are fixed income instruments just like an investment, but they are far more stable and higher in value, usually meant for companies and governments rather than for individuals like us. Governments from all around the world usually issue bonds to raise capital to fund the nation's development, like building more infrastructures, power plants, and likewise for a business, they require far more money than a bank can provide to fund their mega projects, and hence they rely on bonds to raise money from the public debt market. Long story short, that bond rate is usually benchmarked against the US 10-year and 30-year treasury yield, since larger amounts typically require a longer tenor to pay back. So when any economy turns bad, for example during the COVID-19 pandemic like today, institutional investors are more fearful of the current economy, hence why they would typically shift their money from short-term bonds to long-term bonds. That would result in a huge demand for long-term bonds, which increases the price of the long-term bonds. Hence, the return of the bond, or we call it the bond yields, will reduce as a result. Why do you need to know about this? Well, just look at the news we have today. You will notice most of them talk about the yield curve flattening, or in other words, the spread between the short-term yields and long-term yields are reducing. That tells us that investors are not as keen to invest in the short-term bonds and are moving towards long-term bonds. Hence, the difference or spread between the short-term and long-term bonds are shrinking. And to simplify it, it is an indicator of a bear market. Anyways, I'm sure you must have read on the news that the US Fed is planning to raise interest rates in 2022, right? To give you a little background, as you all know, we were fighting against COVID-19 and the pandemic crippled every economy, and unemployment all over the world were running sky high because businesses were forced to lay off their workers. As a result, the US Fed had to reduce interest costs drastically from over 1.5% to zero in a matter of months, and have stayed near zero until today. This indirectly helped businesses to reduce their financing costs because they have less interest to pay, and individuals like us would enjoy from lower loan interest from mortgages or car loans, right? So effectively, it stimulated the economy. The unemployment rate reduces, people are able to save more money because of lower interest expenses, and as a result, people have more spending power and can afford to buy more goods, which also helps stimulate the economy because there are more money in circulation. But unfortunately, that surge in demand while supply remains stagnant on top of the supply chain issue resulted in huge inflation, and prices of goods and services skyrocketed. And as contradicting as it sounds, we are all back to square one, with everyone getting poorer as their spending power decreases, which, as you can guess, result in a weaker economy that could lead to a recession. So this is where Jerome Powell steps in. He needs to raise the interest rates in response to inflation. Not so much, but just enough to balance off the inflation while making sure the economy is still running. So what happens when interest rates increase and how does it affect you? I group them into four main areas. Firstly, on the investment front, you would notice that even the announcement of the potential interest rate hikes by the US Fed alone have resulted in a huge drawdown for growth stocks. This is because growth stocks are typically hinged on their future cash flow generation promises, and if interest rates increases tremendously, this would mean their future cash flow will be reduced as their future interest expenses increase. Hence why the valuation of the growth stocks have plummeted, as opposed to companies with strong cash flows like Apple or Google. Don't get me wrong, no companies are immune to a bear market, because when things fall, everything follows, but only the strong ones can come back from a crash, while the rest, it's up to the resilience of their balance sheet and business model. So for markets like this, the best recommendation would be shifting towards stocks that have strong cash flow generation capability with lower debt ratio. Second, on the borrowing front, a rise in interest rate will affect the interest cost of your loan or mortgage, even if it is just 1%. Let me show you using this home loan calculator. Let's say you bought a 1 million ringgit property, taking a 900k loan with a loan period of 30 years. If your interest rate is 4.0%, your monthly repayment would be about 4.3k ringgit, and your total interest cost over 30 years would amount to 646,000 ringgit. Now, if we increase the interest rate to 5.0%, your monthly repayment would increase to 4.8k, and the total interest cost would amount to almost 840k. That means the 1% increase in interest rate resulted in you paying an additional 194,000 ringgit, which is a 30% increase in the total cost of owning that property. I hope this changes your perspective. That is the impact of 1%. And for your information, the US Fed's rate went from 2.5% in 2019 to 0% in 2020. So imagine if there is more than 2% hike in the interest rate. I'm sure you can do the math yourself. Thirdly, on the savings front, a higher interest rate would translate to a higher return on your cash savings, your fixed deposits, as well as your money market funds. You can usually see this effect take place much quicker than anything else because the Fed rate will indirectly influence the interest rates for almost every central bank in the world, since the US dollar is the world's reserve currency. That said, this will result in an increase in the savings rate of people all across the world, hence less money in circulation. So if not managed well, this can also result in a weaker economy, and to a certain extent for developing nations like Malaysia, the continued depreciation of the ringgit Malaysia currency. And lastly, on the business front, a higher interest rate would typically mean a harder time ahead for businesses with a huge amount of debt and weaker cash flow, and that could end up closing down businesses that can't survive, or result in an increase in the unemployment rate, or lesser bonus payouts, and etc. So just because you think it does not affect you directly, think again. You might just be on the receiving end of this entire thing if your company is not doing well. Wrapping up this video, as you can tell, the rise of interest rates in the US will have a domino effect on the global economy. As an individual or investor, the only thing we can do is to understand it and react appropriately so that you know what's happening rather than just panic hitting the sell button in the event of a recession. What I've covered in this video is barely scratching the surface of the entire finance industry. So if you don't want to miss out on future videos like these, remember to smack that like and subscribe button down below. I hope you found some value from this video. Thank you so much for watching. Stay safe, stay invested, and as usual, I will see you in the next one.